Well, I think that could create a few little wobbles if we do get, say a better jobs number come early part of September, and that will be the defining factor around whether you get a 25 or 50%, 50 basis points cut in that September meeting. But if we get a little bit more strength in the data, that continued resilience in the economy, I think it's quite easy to see that those 100 basis points of cuts are priced out, and we start to see some move up on the bond yields that have been falling quite dramatically in response to that. And this is one of the reasons why we'd be a little bit cautious about pushing too far into duration just at this point, given that those yields have fallen quite a long way in anticipation of this rate cutting cycle and the magnitude of it. And we think we'll be looking for a little bit of backup in those yields, especially if that inflation number comes out a little bit higher, or we see some of the concerns around geopolitics around the world start to fade off, and maybe some of that safe haven buying come out as well.
Kerry, where are you, or how are you characterizing valuations in this environment? I know that Japan and India arguably are diametrically opposed, but when you look at this through the lens of the US equities market, what do you think of these multiples?
I mean, they're pretty high across the board. Obviously, we're looking for that continued shift away from that mega cap names, which are driving the overall index valuations to other parts of the market looking more relatively attractively valued. I think what you saw during early August in terms of the sell-off and the very quick rebound, almost back to all-time high on the US S&P 500, just shows that the sentiment to own risk assets and equities in any sell-off or come down in the valuations is going to be treated as a buying opportunity. So we would expect that to continue as long as we have, fairly decent outlook for earnings coming through for next year, as well as that continued growth in the US economy. We'd definitely be shifting away from those mega caps to a certain extent and looking for better value areas across industrials or financials that we expect to perform a little bit better and have better valuations. So I think there is still a case for looking at equities.
Right.
It's about the earnings growth that's going to drive it rather than the valuations, though, from here.
Interesting shift away from the mega caps, but Nvidia this week, could that throw sand in the gears of that thesis, Kerry, if it restores a faith in the entire AI narrative? And let's face it, the markets have been losing their religion on AI. Despite the high capital spend, they seem to be getting impatient in terms of the ROI.
Yeah, I mean, there's a lot of hope. There's not a lot of confidence built up in terms of what this could mean as a secular theme coming through, high expectations for what these companies are going to deliver, so they're ripe for disappointment. I think for many investors, though, they've been riding this wave around some of these mega cap names for a while now. The positions have probably got a little bit outsized. What you really don't want to happen is the market to rebalance your portfolio for you, which I think is what a lot of people experienced back in August. So that moving away in terms of bringing down some of the size of those positions, of those mega caps, or those techs, into something else seems quite plausible in terms of investment strategy at the moment. We do believe there's a long run theme here around the need for these chips and what it can do for the economies and markets around the world. So if it does get tested in the near term, that's one thing. But I think there's a longer term goal here for many investors around why they want to own these growthier stocks in the long run. I think in the short term, it's just providing a little bit balance in those allocations and equity positions and portfolios that may have got a little bit out of whack given the run we've seen in the market so far this year.